Hey, welcome back everyone. It is time to talk about using margin for dividend investing. Now this is going to be a video where I talk about using margin to buy a dividend paying stock. What I want to do is generate cash flow, have it pay down the margin debt, and hopefully in the end we will have free and clear cash flow for which we would have free and clear shares of this high yielding dividend paying fund. The purpose of this video is to talk about margin requirements, and we're going to talk about that margin buffer. So the two topics in this video are margin requirement and how that affects your margin buffer. Margin buffer, or what they call non-margin buying power, is very critical because if you don't give yourself a margin buffer, you will get a margin call. So in this video, we're talking about those two things, and I know you'll come away with a better understanding of how we use margin correctly, giving ourselves a buffer. Now you can download my smart guide to using margin for dividend investing or dividend income. And in that guide, you're going to see various chapters talking about all things using margin for dividend investing. Because I know a lot of people out there want to use margin to collect more income. Well, I want to do it the right way and not be influenced by people on YouTube talking about how easy it is, but they don't talk about the things that can actually break you, because you can actually lose more money than what you're putting up. Now, I hope you enjoyed these educational videos. If you do, I want you to subscribe to the channel. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now, what we're doing is talking about using a dividend paying fund on margin. Now, this is a real trade. This is live. I started this trade February 28th, 2025. And my last dividend payment is May 9th, 2025. Now, I got involved in this right before the stock market corrected. So we had a little issue with the fund that I selected falling tremendously. And what I want to highlight about that is that my fund, my high yielding dividend paying fund, fell considerably and I didn't get a margin call. That's what we're going to talk about here. So we are using IWMY now. I originally bought QDTE. I talk about why I shifted out of QDTE in other videos, but now I have IWMY. So this is to generate weekly dividends, pay down the margin debt, and when you pay down the margin debt, you're basically collecting shares free and clear, or you're taking out cash free and clear, but do understand you're not reducing your margin debt. So I want to bring you up to speed. I do own IWMY. I originally owned QDTE. We went ahead and sold out of that position. We're down some 18,000 on QDTE. Talk about bad timing. The reason I mention that is because when I bought QDTE, I left myself a decent buffer, a decent margin buffer. I was able to sustain not getting a margin call during the overall stock market falling some 21%. It's all about giving yourself a little bit of margin buffer. So if the stock market were to ebb and flow, when it ebbs lower, your brokerage doesn't call you up and ask for more collateral, that being a margin call. We'll take a look at that here in a minute. So that's the setup. Let's talk about understanding margin requirements and that margin buffer. Now, the margin buffer is called non-margin buying power, but on YouTube and many places, you'll hear them say margin buffer. So we're going to say margin buffer the rest of the way. So our margin requirement shapes the entire usage of our margin. I'm going to show you an example of that. Here you could see in example A, if I'm using $10,000 and I buy a dividend paying stock that has a 30% margin requirement, I can borrow up to $33,000 if I had $10,000 in equity. Now, equity is collateral, could be a stock, it could be cash. Now, if it's cash, it's 1-for-1, and then your 30% requirement allows you to borrow that. If your equity was a stock that might have a 30% margin requirement or more, then you won't be able to borrow that amount of money that example shows. So why do we care about margin requirements and our margin buffer? Well, it's to avoid a margin call. A margin call is real. A broker is going to extend you credit, and you could see if you had $10,000, they're going to let you invest up to $33,000. If your collateral does not meet the standard for which your broker has set up, Well, you're going to have to pony up collateral, or you're going to have to sell shares that are depressed. And if you get a margin call and your broker actually takes action, they will sell equal amounts in every single position you have to bring up your collateral. So it's one of the most dangerous aspects of using margin. If your portfolio drops in value below the threshold or the margin maintenance, your broker can demand additional funds. That's the collateral we're talking about. And it's fast. They want it within a day or 2 days. Now, if you cannot provide that cash because you might not be able to, chances are you're already flying by the seat of your pants. You watch some guy on YouTube and he's showing you how to do it, but now you're in a margin call and he's nowhere to be found. Well, they're going to have the right to sell your securities without your permission. And that's just the way it goes. You could lose potentially more than you invested. That is the worst possible case. And the stocks are down, so that's the worst possible time. Now, I did mention IWMY. And IWMY is a high-yielding dividend-paying fund. There's a family of them out there. Different companies using different strategies. Some even use single stocks. One of the big problems is what they call NAV erosion. Because a lot of these high-yielding dividend payers use cash and they use synthetic option trades, they're able to generate a lot of income. But that means their NAV is largely cash. So when they distribute all those big dividends, they're distributing a lot of their NAV. If the ETF, like IWMY, does not move higher in value from the time it distributes its dividend to the next dividend, well, technically they took away from the NAV, the net asset value, before they were able to replenish it in stock value. So what happens is NAV erosion. The chart on the left is if you took all those dividends and put them back in to IWMY. You can see the chart looks incredibly different than the right. Now, to be fair, the chart on the right shows IWMY back when it was a monthly dividend payer. Now it's a weekly dividend payer, and at the bottom of the right screen, you could see we have NAV stabilization. You could see back when they went from monthly to weekly, right around the beginning of 2025, you don't see that NAV erosion as much. Well, then the overall stock market fell. What I need you to understand is NAV erosion. In the Smart Guide to Using Margin for Dividend Investing, I have an entire chapter for NAV erosion. And I need you to understand that, because if you don't, then you'll feel like you're losing while you're collecting all these weekly dividends. Now let's go back to that margin buffer. And this is where we're going to interweave margin requirements with the margin buffer. So I'm going to keep this as simple as possible. And I know for a lot of you, it's Mr. Obvious. But here's the deal. A lot of people are confused. They don't understand it. So I'm going to try to make it simple. And I'm going to use my example of my current trade with IWMY. When you apply for margin, say you have $10,000. Well, they're going to give you a certain amount of margin. Now, in my example here, it's not $30,000. Chances are they're going to give you less than that. But that 3 times is going to play a role here in my next slide. Because as I already mentioned, we're going to be able to use 3 times our collateral. And that's important to know because now we're leveraging up. And this is where I really want you to listen if you're really interested in using margin for dividend investing. Look, you have a glass. Look, I'm going to use an analogy. You have a glass, and that glass can be filled up with margin. That's debt. Well, your collateral that you brought into this investment, well, that equals 100%. Now, let's have that glass of debt, and this is the margin you're going to use. If you use a high-yielding fund like IWMY, which I'm not recommending, but it's a part of that family of high-yielding dividend payers, well, they're going to be in and around 30% margin requirement. So now when we buy shares, you're using your margin calculator, you're starting to buy shares. And what's happening is it's filling up that cup of debt. All space in between is what they call your margin buffer. So imagine I go ahead and I buy some IWMY. And let's say I buy 30% of my 100%. Well, the other 2/3 is going to be my margin buffer. What this means is whatever that number is, your account, your entire account fluctuates. And it can fluctuate as much as that margin buffer. This is where people get wrecked, because what they do is they begin to fill that debt glass, and they don't leave themselves a buffer. They're maxed out on margin, and guess what happens when the stock market falls? Well, their non-margin buying power goes from a positive number to a negative number, and you get a margin call. You're going to have to produce the collateral. You're going to have to sell these shares that are now down, or they're going to come in and do it. And I'm telling you, they are going to do it. It's very important to understand when we use the 30% margin requirement ETFs, we could start to fill up this debt cup, and we could actually make some good money. But you have to leave yourself a cushion. I want you to understand, when I did this trade, I could have used an additional $20,000, but I left that there for margin buffer. Do you remember when I told you that QDTE during the market crash fell $18,000? Well, here's the deal. My margin buffer was sitting at $20,000 at that moment. When all was said and done, all the blood's in the street, I was down $18,000 on QDTE. But my margin buffer was only down $14,000. I never got a margin call, and that's how you play this game. Look, you're going to have a bag of money you bring to this game. They're going to give you a bigger bag of money. It's so important you understand about that margin buffer. Leave yourself a margin buffer. Now, what is the margin buffer? It's not the stock you buy. It's the entire account. So if you're sitting with a margin buffer of $5,000 and you got IWMY in there and you've got a leveraged ETF in there like SOXL, and SOXL drops by 50%, well, guess what? Your margin buyer is going to get sucked up even if your high yielding dividend paying fund didn't. And then you're going to have a margin call. Ensure that you understand this debt cup you're filling up, you got to leave yourself a little bit of buffer. That's where people on YouTube are getting wrecked. They went full margin because they were listening to people that would go full margin. And then they get wrecked. And I'll tell you what, they're not talking that big game on YouTube anymore. Now, we're going to do it right. And how we do it right is when you use the margin calculator. Members, just go to the download hub. It's there. So let's do a quick recap, but let's also look at the margin calculator. What is margin requirement? When trading on margin, it's not just about how much money you borrow, it's also about what you're borrowing against. Each stock or ETF you invest, it comes with its own margin requirement, which is the minimum amount of equity you must maintain in your account to the relative position. This is where, when I have a 100% cup and I buy a 30% margin requirement ETF, I'm able to go 3 for 1. I want you to use the margin calculator because we plug in all these numbers. You can see when we use $10,000 on margin and we have a margin interest rate of 8%, you could start to paint a picture as to what your free and clear cash flow will be. I want you to use that margin calculator because you have to know your numbers. The initial trade setup does that. This is golden rule number 1 of using margin for dividend investing. Run the initial trade setup so you know your numbers. Now, why does all of that matter? It's because we're trying to avoid a margin call. How incredibly stressful will it be if the market takes another tank and you're in for $33,000 in debt, in margin debt, and you can't pay it? This is why we use calculators and we make sure we track all of our profits. We understand where we're at in the trade, and we definitely leave ourselves a margin buffer. The tax bucket buffer tab inside the margin calculator could be used as a worst case scenario tab, a worst case scenario setup where you plug in the ETF just like I did, IWMY, the amount of shares we went on margin for, 414 in this case, and then we pick a stock price that is worst case scenario. And in this case, I picked 19. IWMY could fall to 19. And when we plug in what our margin buffer is, and I'm just going to put in 10,000, you can see what happens. If IWMY falls to 19, I'll still have a margin buffer. I'm not going to get a margin call. Why does this matter? you can feel like you're doing margin the right way. Not going to say safe, because you're going to go out and make your own investments. We're going to do it the right way, and the right way always starts with knowing your numbers. Now look, the bottom line for Chapter 7, which is in the Smart Guide to Using Margin for Dividend Income, which you can download. Go to the Members Hub. It's right there. Download the entire guide and download the phone app. The phone app's going to be available here this week. Look, the key takeaways to this entire discussion is that each ETF has its own margin requirement. It's based on volatility, liquidity, and brokers' rules. Riskier assets have higher margin requirements. Remember that glass that we talked about? And you had this glass of collateral, which is 100%. Well, if you went out and bought an ETF that had a 50% margin requirement, you could only borrow up to 50%. To maximize your dividend income, you would pick the 20% or 30% funds. IWMY is the one I use, but there's many others out there. So of course some securities are not even going to be marginable, but chances are that's not going to be what you're going to do or I'm going to do, because we're looking for dividend income, because we want the dividend income to come in and pay down our margin debt. See, that's the most important thing we want to understand. When we collect this cash flow, it's going to go in and pay down our margin debt, which is going to increase our buffer. And then, if you play the long game, if you keep these shares for the long game and your numbers work out in the calculator where you're collecting free and clear cash flow every single month, what's happening is you're reducing your margin debt, you're collecting free and clear shares, and if IWMY or the ETF that you pick is zero, sold at cost basis, well then everything's left on the table, right? All the money's left on the table. The money you put in, the money you got, the money you paid out, it's all left on the table. Because if I'm able to sell IWMY at a cost basis for which the investment is zero, then all those fat dividends are now on the table. Look at where I'm at right now. Right now I'm about 11 paychecks in, and we have $4,800 on the table. Now, I'm paying a high tax man number of 25%, and I'm paying that margin interest of 8%. That's $2,800 in free and clear tax flow or shares. Because when I close out this trade 100%, that is free and clear. And I'm going to have all those shares sitting to the side. That is how you use margin for dividend investing right. Hey, look, I'm going to leave it there. Chapter 8 in the Smart Guide to Using Margin for Dividend Investing. I love saying that. You know why I love saying that? Because I want to use margin right. And we're going to use it for dividends. Those dividends are going to pay down the debt. We're going to have that cash flow coming in. I want you to know how margin requirements work when you buy those individual ETFs to pay you those dividends. I want you to ensure you have a margin buffer that works where you have enough buffer if the market falls. Okay? That's the most important thing here. We want to use margin the right way. Because if you use margin the right way, it can be highly profitable. And I'll tell you what, it slowly takes away the risk, right? Hey, everybody uses credit cards all day long out there buying stuff, paying bills. But for some reason, when we talk about using margin to bring in cash flow, everybody's scared, man. They run to the door. They don't want to hear it. But yet they'll go out tonight. They'll use that credit card to pay their bills. They'll ultimately pay it every single week or month with the paycheck from the 9 to 5. Well, we're paying our margin debt with the dividend income. And it happens automatically. This all happens automatically. I'll tell you what, follow me to use margin for dividend income the right way. Hey, look, subscribe to the channel, bang that like button. Be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.